Hey guys, TommyBryson here, and today I want to talk about exactly how do you pay off a 30-year mortgage in 5 to 7 years. Now, I've been doing some research on this topic, and basically every single video I watch on YouTube takes around 30 minutes to break this down, and I'm going to try to do it in half the time to actually break it down. But on top of that, I'm going to give you guys also an easier method to actually do it, and that's the goal for this video. But I will break down exactly how everyone else is talking about, like, hey, how do you do velocity banking? How do you do extreme payments? How do you finish your mortgage in 5 to 7 years? I'm going to break everything down in this video right here. And by the way, if you're new here, I post videos every single day, so make sure to also subscribe to the channel and hit the bell so you're notified. On the top of that, also destroy the like button. I really appreciate it. It helps a lot, so thank you guys so much. Now, the first thing you need to understand to basically go out there and pay your mortgage off in like 5 to 7 years, although it might be a 30-year mortgage, is basically how does your property accumulate equity? And by the way, equity is basically the money you actually get in your property after making payments, or for example, having your property grow in value. So there are only really two ways to actually have your property gain equity. For example, you bought a property, it costs $200K, you put down $20K. Well, $20K is the equity you actually have in the home. The money you actually pay towards the actual home. That's the equity. On top of that, say for example, your property grew in value by around $25K. Well, you also have $25K in equity based on appreciation, based on value. That's how it works. Now, there are three ways to get that equity out and use it for yourself. For example, you can get a home equity loan, or for example, refinance, or for example, get a home equity line of credit. Now you're probably wondering, well, Tommy, why do I care so much about borrowing money and using my equity? Why does that matter? Well, the answer is this strategy right here, which is also called like velocity banking, only works if basically you borrow money against the equity you have in your house. And you might say, Tommy, that makes absolutely no sense. Why would I borrow money to then go ahead and use that money to basically pay my mortgage? That makes no sense. It sounds like I'm basically borrowing from Peter to pay Paul. Well, I get that, I understand that, but in reality, it is a little bit more complex than that. And here's why, okay? Say, for example, you bought a house. It costs $200,000 and you paid down around like $40K. So you have that much equity there, right? And on top of that, it went up in value by around $20K. So with that $20K in value and also $40K you paid down, you have a total of around $60K in equity. Now, whenever you actually get a home equity line of credit, which in a way is like very similar to like a loan you get when you actually get a credit card, but it's actually backed up by your property. If you don't pay, they take your property. Well, the answer is, guess what happens, guys, okay? Whenever you get a Heloc, a home equity line of credit, they give you around 80% of the equity you actually have in the property. In this case, say you have $60,000 in the property, well, they give you 80% of that, which is going to be around $48,000. Now, Tommy, what exactly do I do with this money right here? Do I take the money, get a new kitchen? Do I get a new car? Do I get, for example, a new house? I don't know what to do with it. The answer is some people grab this money and basically go ahead and buy a new property. But for this video right here, we're going to grab this money and pay your mortgage with it. What? That makes no sense, right? But in reality, it does. And let me explain exactly how you can use this method to basically lower the amount of money you pay in your mortgage, but also pay it off a lot quicker. But there is one thing, okay? This only works if basically you make more money than you spend every single month. For example, you make $4,000 but only spend $3,000. It doesn't work, for example, if you make $4,000 but spend, for example, $4,500, because basically you have credit card debt and a whole bunch of loans and also an auto loan. It does not work for you if that is your case. You need to have extra money coming in, and that's the only way this method is going to work. The idea is, once you grab that $48K that you got from your Heloc, you grab that money and you pay your mortgage with it. Now, here is what happens when you do that. It means that basically every single month, you're going to pay less money on your mortgage. Yeah, Tommy, that's true, but I'm still gonna have to pay that Heloc. Well, in reality, the Heloc is usually going to be for around 10 years or so. And the strategy to lower the amount of money you pay in interest towards it, by the way, the average Heloc costs around like 5.17% in interest, but it is also variable. So for example, if the economy does go down or something happens like crazy, the answer is they could call your loan, or for example, raise the rates to like around 9 to 10%. So keep that in mind. But right now, in 2020, around August or so, it is around 5.17%. The strategy is this, guys, okay? Every time you get paid, what you basically want to do is take all the money you get paid and put it towards to pay your Heloc. Tommy, how the heck am I supposed to live and pay my bills if all I'm doing is basically paying my Heloc? The answer is, remember, the Heloc allows you to basically grab money in and out whenever you actually want to. So it's basically like a credit card, but a very fancy one, okay? And by the way, some companies, banks actually give you a debit card or a credit card along with your Heloc amount of money you actually have in it, because basically you can use it whenever you actually want to use it. Now Tommy, okay, what do I do next after I put all my salary into the Heloc? Well, the answer is what you want to do is, meanwhile, what you want to do is use a credit card to basically go out there and use this credit card to cover all of your expenses. For example, your food, your gas, all of your bills, and just put it on the credit card. Now, as you guys know, a credit card does not charge you interest until the end of the closing period. And usually that's around 23 days to sometimes even 30 days, depending on your credit card. You want to find out by calling the credit card provider. And the idea is, once you actually put your salary in the Heloc, you want to leave it there for 30 days, use this credit card for 30 days also, and pay it off in full before they actually charge you any money. Tell me with what money? The answer is, grab the money from the Heloc, and that's how you actually pay it off in full. But how the fudge does this make sense? It sounds like I'm borrowing, and borrowing. Well, in reality, because the Heloc is going to charge you interest based on your average daily balance, the answer is the average daily balance is going to be basically what you basically paid it from your entire salary. But once you pay off basically this credit card, it won't charge you any interest. So basically, by using the credit card, you basically get to pay less interest on the Heloc because you had a very low average balance, because basically you put all of your salary into it. But again, this only works if, for example, all your expenses are 3K, so you pay off the credit card, the mortgage of 3K, and you still have, for example, 1K extra to actually pay down the Heloc balance. That's the only way this works, because if it doesn't work like that, basically you're just accumulating debt over there and here and also with your mortgage. It does not make any sense like that. So the idea is, you want to, if you make 4K, you put the 4K in the Heloc. Once you have, for example, 2K here in expenses, you pay this and you also pay the 1K in the mortgage, and you leave, for example, 1K in the Heloc to pay itself off. This way, you're basically getting a lower interest rate, getting to get points here, and also lowering the amount of money you actually owe on the mortgage. That's the idea. In a way, what you're doing is a fancy way to basically pay off your mortgage with extra payments, but basically do it in a way where you're actually saving a lot more time. That's the concept of how the Heloc strategy works to go out there and pay your mortgage off faster. Now, by the way, keep in mind, if you're paying all your expenses with a credit card, you're basically getting points and also free money by doing this also. Now, by this point in the video, you're probably either confused or you probably get it. But by the end of this video, you will all 100% of you most likely get it. But if you don't get it, just comment down below and let me know, and I'll answer your questions also. Now, overall, guys, the entire idea of the strategy is basically you're making extra payments towards your mortgage, and you're also leveraging interest rates to then get a lower rate, and on top of that, getting credit card points. Now, it's a very simple thing to understand, but in reality, it's a very complex thing to actually put into action. But step by step, what you're doing is basically, you're getting a Heloc, right? You're paying off your mortgage with it, the full amount you actually got from the Heloc, and then basically putting your entire salary in the Heloc, leaving it there for 30 days. While you're waiting for 30 days, you're basically using a credit card to pay all your bills, and then at the end, before the credit card charges you interest, you pay it off in full with the Heloc, and you leave the extra money in the Heloc. That way you're actually paying it off every single month, right? That's the concept. That's the idea. That's the strategy. You get to leverage interest rates because basically you owe less money on the Heloc than you actually do with the entire mortgage. That's the easy concept and the easy way to actually understand it. But there is a problem with the strategy. And the problem is that basically Heloc interest rates are not fixed at all. They're variable. So for example, you can go from 5% today to 9% or 10% tomorrow. On top of that, a credit card, if you don't pay it off, you go into default, they ruin your credit score. But a Heloc, if you don't pay it off, guess what? They take your property, bro. They take a lien against your property. So in reality, you can be out your entire property if you make a mistake, or for example, the interest rates get way too high and then you can't afford to make your payments. So in reality, it is very, very risky if you do this strategy. On top of that, that's not all. If you don't have the best credit score, then they probably won't give you the best rate. So it will be very expensive to actually do. And guess what? Some people basically do the strategy, and then midway have an emergency, and then boom, they have to take money out the Heloc, and before they know it, they just ruined the entire thing. So now overall, if you ask me, Tommy, does this actually work? The answer is it works. Mathematically, it works. It'll save you money and you'll be done a lot faster. But also, this requires someone that basically wants to have a very fixed budget, wants to make sure everything is basically how it's supposed to be aligned, and wants to keep track of everything every single month. Because basically, if you make one mistake, you lose your job, you could be out of your property and you could be in massive trouble. Or for example, if the interest rates go up, what are you going to do? And if you don't have, for example, an emergency fund to actually get money if you lose your job, you might have to take money out the Heloc, and that's going to be a massive headache because basically you're going to borrow money from money you actually already owe, and before you know it, they foreclose on your property, and you just might be in a huge financial disaster. So if you ask me, Tommy, would you do this? The answer is I do not want to go through all that stuff, okay? The answer is you have to be very specific, you have to do everything you have to do to make sure everything is in line. But in reality, what I rather do is this. Although it's going to be just a little bit more expensive, I'd rather just pay more money towards my mortgage every single month by having extra payments, but not having a Heloc and being worried about interest rates and being worried about everything else. The answer is I'd rather just make more money towards my payments on my mortgage and be done with it a lot quicker. Now tell me, how do I do this? The answer is go online and search up a early mortgage payoff calculator. For example, NerdWallet has one. And by the way, guys, I'll also leave a link down below to a calculator. It's also free, so link down below to that. And the idea is with the calculator, it tells you exactly how much money extra you have to pay towards your mortgage to be done at the deadline you actually set for yourself. For example, if I have a loan and it's $200K and I owe, for example, $160 on it, like $160,000, and I want to pay it off in 7 years, the answer is all I have to do is pay around $2,114 every single month, and then boom, be done with it in 7 years, and boom, everything's done. But I'm not worried about interest rates, the Heloc. They called my loan because, by the way, if the bank feels like you're not going to pay, they can call your loan and basically have to pay the loan, all the money right then and there. And if you don't have all the money, what the heck are you going to do? That's the answer, okay? That's the problem with the strategy, but I wanted to teach it to you. That way, if you want to get into it, you can if you want to, but if you don't, just go ahead and pay more money towards your mortgage. That's the idea. Simple, easy, and no headaches. That's what I would do. And by the way, guys, right now, there are YouTubers out there recommend this method, but if you don't understand it, they tell you, hey, just hire me and pay me one time $4,000, and that way you'll save a ton of money. But in reality, all they want to do is have you pay them money. You know what I mean? So basically, this video right here is non-biased. I don't want your money. I don't want consulting fees. All I want to do is give you all the information, and that's what I just did in this video right here. So hopefully it helped you, okay? That's my goal for all my videos. But guys, comment down below and let me know exactly which one are you going to do. The Heloc method, velocity method, the early payment method, or for example, just pay more money towards your mortgage and be done with it a lot faster by using a calculator. Comment down below, let me know. And by the way, when you comment down below real person, because I'm also predicting there are going to be a lot of bots in the comment section down below. So that way I know you're a real person by commenting down below real person and then your comment, okay? I'll see you guys tomorrow. Thanks for watching. As always, like this video here, well, like this video. On top of that, also subscribe and hit the bell so you're notified. And if you want to talk to me one-on-one, well, follow me on Patreon. Link down below to my Patreon. Or for example, just DM me on Instagram, TommyBryson. And before I go, if you want to watch another video basically on how I invest my money, watch the video right here. And I'll see you guys tomorrow. Thanks for watching. And as always, peace.